Today, from the investment manager's frontline. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. And today, I'm joined by Tony Locantro over in Perth. Hello, Tony. Good to see you.
G'day, Martin. I've always wanted to meet you. Even electronically is fine.
Digital's pretty good these days, isn't it? It certainly helps to get around. So I really appreciate your time and coming on and talking with our viewers here. And I think you've got a really interesting perspective. Partly you're in Perth, and partly, of course, you, from an investment management perspective, are looking across a number of different asset classes. So I think it will be a really interesting conversation. But I guess the first part would be, let's just understand a little bit about yourself and your background and the business that you're running.
Okay, I was brought up on the northern beaches in Sydney, so grew up there. Then I went to school in Chatswood, which has transformed a lot. And I was one of these types that wanted to go to uni, and I thought, stuff it, I'll just join the police. So I went through Goulburn Police Academy, then was stationed at Waverley and Bondi. And one of the good things I remember about being a cop in Bondi was I was able to buy a unit about 500 metres from the beach. Right. And I was about 500 metres from work. And I just don't realise how lucky I was. I mean, I could walk down for a surf just in my wetsuit and a towel, walk back, get my police uniform and to work. And that was when my price to income, I paid 2.4 times. And people say, well, what's different? And I'm saying, well, now you can get a deconstructed Vegemite on toast. That doesn't justify it. So look, I got to acting sergeant in New South Wales Police. So I ended up, my last police station was Canterbury, but I was on the transit. So my patrol, Martin, was the whole of Sydney. So right. I got to know all the pockets around Pennant Hills, Castle Hill, all the way to Cronulla and out west, pretty much to about Blacktown. So I got to know the places, the congestion and the people. And I think that's what I'm really fascinated on. I did a year in the police in Gympie because Queensland Police offered us more money. So it was like a poaching. So I joined them and they said, you'll go to Maroochydore. Nah, I ended up at Maryborough. So in a trade deal, I got Gympie. So again, that was a bit of an eye-opener. But when I came back to New South Wales, I was stationed in Petersham, which is a beautiful area. And I found a lot of my time I was in Norton Street Leichhardt, which was probably a little bit naughty because it wasn't in our patrol. But I think, interestingly, Petersham is probably the area in Sydney that's corrected the most recently, but I've got a good idea about Stanmore, Newtown. I was briefly in Newtown Police Station, and again, that area was driven by the lesbian, gay, transsexual money, which has driven those prices, which is great. I wish more suburbs in Perth would see a greater influx of gay people. Because they do a lot for a community, and that's why prices in that inner west have overshot. So I became a stockbroker in 1998 and straight into the biggest bubble of our generation, which was with .com. So I ended up pretty much writing my yearly salary in a month in the .com bubble. And I built my client base up to 500. And what I did, I learnt what made people think. And it's funny how a speculative bubble unravels, how a lot of people were fair weather friends, where they're your best mate when things are going well, they don't want to sell. Then suddenly there's a hint of fear and it's capitulation. So I specialise in small cap stocks. So I've seen September 11, which was pretty bad. I've seen .com, Post, uranium, milk powder, medical marijuana, potash, potassium, ABC childcare centres. I've seen every bubble. And what I've done is I've learnt human behaviour, and that extends from my policing days and dealing with clients in fear, greed and stupidity, Martin. So that's my background. I live in Perth. I came over to Perth for mining to be a broker. And I'm fascinated by markets. I think real estate markets, fascinating, and especially the area I live in. I think I've bought in the best area in Perth, and it's affordable. So I live 3.5 kilometres from work. Pretty much 7 kilometres to the beach and 5 to the city. I mean, what more do you want? So think about me.
Very good. And it's interesting. I think you're highlighting something which I've noticed, and that is there is a whole psychological element to the investing and buying real estate or whatever else, right? Which I think is often underestimated. So people perhaps are assumed to be logical, rational animals when it comes to buying and selling. And I think often people miss the fact that there is huge sentiment swings, and there's a whole bunch of psychological issues. And in fact, you can see it in spades now, I think, in the property sector, because effectively, on one hand, you've got the fundamentals, and then you've got the opinions and the psychology, and they may be pulling in two different directions.
Yeah. So I try and combine a bit of both. And what I'm seeing is some of the ugliest indicators I've ever seen. It's it's like Homer Simpson in Y fronts. It's just not sexy what I'm seeing. And I think, look, the good thing is though, when I started talking about this on Sky Business, it was 2015 where I said I saw a sale in Castle Hill and it's time to sell all the bank stocks. So really, people have had 2 years to sell. Admittedly, the last year Sydney's dropped about 6%. So everyone that wanted to get out has had a chance. And I think psychology is fascinating because I've noticed it since I deal in a lot of small cap companies. I mean, some of my companies have increased 50 to 100 times in value and others less so. But people go through this stage where I call it peakitis, where a stock's 10 cents goes to $1, and then the client refuses to sell at 90 cents because they expect $1. And I think you could see that in Sydney, because when Sydney peaked at an astronomical 1,157,000, that's crazy. Suddenly, no one will accept 980. But I think that's psychological, and that's going to have an impact, Martin.
Well, it's interesting because I survey households all the time, as you may know, and what I'm noticing now is that whereas 6 months ago a lot of investors were in that state where they said, no, we're not going to see prices fall, we're now starting to see property investors in particular say, no, I want to get out, and I'm prepared to take a hit now, because my concern is that if I don't get out now, in 6 months or a year or 2 years, I'll be taking a bigger hit. And so that sort of swing in terms of psychology amongst a lot of investors really has only come through in the last few months, certainly in and around Sydney. I would say that in some other states, that has not yet moved. So we've still got people who are thinking the price is there and I'm not prepared to sell for less than that. But I've noticed in Sydney a big change recently.
Yeah, I guess a friend of mine who bought a house 10 kilometres from the city in Perth in 2006, she hasn't made a cent in 12 years. So a lot of people in Perth, we are in a normal market. Admittedly, historically, Martin, it's still overpriced, but there's no hype. But those agents in Vic Park or around Leederville are doing huge volumes, and often the greatest volumes at the bottom. So I've also looked at the Adelaide market. I should really immerse myself in it, but there's some great buys in Adelaide, like a nice townhouse in West Lakes for mid-threes. And Westlake Shores is a beautiful area. But what I'm seeing in Sydney is that the whole market was from Mount Druitt. I grew up in French's Forest, so those houses are just off the charts. Admittedly, they've got a new hospital there. Eastern suburbs, well, that's a joke. I think you're paying 16 times now in Bondi. So that's a whole market, and what I think is going to happen is we're now seeing it correct, and vendors aren't being realistic at all. I watched an auction of a unit in Bronte. It was on Your Money, the channel, and it went for 1.377 million, a dilapidated 2-bedroom unit. Admittedly, you could hear the waves crashing, but that unit's going to cost 1.6 to get up to livable standard, but it's worth $800,000. It's crazy. It's absolute crazy. And even the property people on that channel said it should fetch 9. So whilst you see pockets of that madness, people will still have hope. Now, what I'm thinking, sometimes markets crack when you have the complacency stage. So if, just say, house prices have been falling heavily in Sydney and Melbourne for 12 months straight, maybe that rate might slow, or we might even see a small bounce. And I think that could breed the dangerous complacency that will see this market capitulate. So watch for that.
Yeah, well, certainly it's interesting because I do a sort of a postcode by postcode analysis, right? And it's worth saying that the property market is not a single market, not even in a particular geography, right? It's lots of micro markets with different types of property, different price points, different supply demand drivers. And in fact, in a few suburbs, I've noticed that prices have moved less down in the last couple of months, but in others, they've started to drop significantly in recent months. So, people actually have to understand that you can't talk about in generality about, what the average price is doing. So 8% in Sydney doesn't tell you anything. You need to get granular. You need to understand the different types of property. And in fact, you're right, I think, insofar that there are people who are, and I still hear them in the real estate sector saying, well, prices have not quite fallen as far this month as last month, as though that's the start of the U-turn up. The point I would make is that the big change this time is the lack of availability of credit. And just as greater availability of credit and greater loan-to-income multiples drove prices up, so the lack of availability of credit and the reduction in lending standards can only drive home prices one way. And there is no way, I think, those lending standards are going to get loose anytime soon. And I'd also say probably that we're now getting sort of towards more realistic loan-to-income ratios, although still way high in terms of historical terms. So in Sydney and I think in Melbourne, it's going to be hard to see other than prices slight, and that's one of the things that I've been saying in terms of my view. We come to Perth a little bit more because I think the Perth market, a lot of people won't understand the Perth market because essentially there's been little capital growth there for 5, 6, 7 years now?
12.
Okay.
There was a peak in 2014. I built a 5x2 in Eastwick Park, which is 6 kilometres from the city. It's a blue chip suburb. And we were heading down the interest-only reset. And there was a little spike in Eastwick Park. And I said to my wife, our mortgage payment's going up 25, 30%. We need to sell now. And we're expecting a lineup of people outside our home open. It was crickets. Not one person showed up. I went to the highest volume mover in Eastwick Park, a very nice lady who does all the volume, and she got us, there was just one buyer and we had to sell. And I said to my wife, when we build our house, you need to build something that other people will buy. So she said, look, when I'm cooking a roast, I'd like to do the potatoes at the same time. So we had 2 ovens and we had Esther Stone bench tops and we had a spa bath, which I used 3 times. And a buyer comes in, oh, wow, I'd love to live here. Sold. Thank you very much. Now, Perth, it's fascinating because I've started going to home opens again. There's a suburb I went to a party on Saturday night called Kouk, and it's a beautiful suburb, not far from the city, tree line, beautiful houses, but you don't drive through the suburb. And some decent houses there at $2.3 million. And that's beautiful. And what I do, Martin, I look for that next up-and-coming suburb, and Yokine, which is 6 kilometres from the CBD, good access, good cafes, I think it's the next Kouk. And if I had the money, that's where I'd be starting to accumulate now. So, look, I am a property bear, Sydney and Melbourne, but, geez, Perth is a wonderful market. And I'm not going to leave the first home buyers out or those that are just starting, but Glendalough would be my pick. For $280,000, you can live 6 k's from the city, 8 kilometres to a beach, and you're walking distance to Innaloo, which is going to be Perth's largest shopping centre, and they're going to spend $600 million on it. So for $280,000, maybe might drop to $250. I mean, what more do you want?
It's very interesting because the ones that you've been talking about there are relatively close into the centre of Perth. I certainly see some different dynamics closer into Perth compared with up and down the coastal strip, sort of down to Mandurah or north, where it looks to me as though there's a whole lot of pain with prices continuing to slide with very high levels of mortgage stress. And, the view that I have there is there's probably very little upside in some of those other areas. So it goes back, I think, again to granularity, to understanding the local markets and understanding that not all markets are the same, and then, picking your battles.
Well, I think Baldivis became HSV, FPV paradise. All the hotted up cars, beautiful homes, but that's now becoming the bankruptcy capital of Perth.
Right.
And Baldivis is where you could afford to have parking room for your boat, but unfortunately, it's 45 minutes from the city, and there's a huge struggle there. It's been well publicised. Now, a lot of my clients that have made a lot of money out of gold stocks, I've said, just take some money out of your gold stocks and look at the Perth market, and they've agreed with me. Probably my favourite suburb in Perth is Leederville, which has taken a lot away from the CBD. Admittedly, on a Friday, Saturday night, there's far too many 20-year-old girls walking around without their shoes. Oh, look, you're going to get that element. But, yeah, Perth's fascinating. But, again, I'm expecting Perth to get a 5 to 10% downdraft based on what's going to happen in Sydney and Melbourne. So I think it's going to be a buying opportunity.
Yeah, I was going to ask you about that, because clearly, you know, if you think that Sydney and Melbourne is where a lot of the centre of gravity is in terms of, you know, the property sector, the spillovers into other markets is something which I've been studying. And, you know, Tasmania and Adelaide have been rising relatively recently, although we're seeing a bit of a slowing there. Brisbane is, I think, probably already sliding. And so my view in Perth was that the chances are that it's going to go sideways or down slightly, but the drops will be nowhere as significant as down the East Coast, partly because it hasn't run up over the last few years, and partly, as you say, there's just a very different dynamic there. So again, it goes back to this idea that the property market is not a homogeneous set of things. It's actually quite diverse.
I think if the Chinese turned right after Melbourne instead of going straight ahead, Adelaide would have had that 15% run. So I think the Chinese buyers didn't put their blinkers on; they just kept going straight. Otherwise, Adelaide, would have had that 15% rise. So I liken Hobart to a battery metals investor. He's bought the lithium, he's bought the cobalt. Hobart was the high purity alumina or the vanadium. That's the way I see it.
Right. But of course, there again, it's a matter of relative volume, right? So you may see a little bit more growth in those two markets, but in terms of the total volume of deals being done and credit being written, it's a very small proportion of the total. So in a way, whatever happens in those small markets, it's not going to offset the significant drops in the major markets that I think is probably there. And I guess that sort of takes us quite nicely into the bet, right? So, you know, for those who've been following this a little bit, I did the 60 Minutes thing and said that, worst case, it could be 40 to 45% down over the next 2 or 3 years. Not saying it will, but I said it could. And Stephen Koukoulis basically came back with a bet that would actually, I think, was quite a generous bet. But I don't gamble, I don't bet, so I didn't take it up. But you did.
I did. And when I saw it, I thought that 60 Minutes story was very well done. And but now people are saying, well, 60 Minutes credibility is in the gutter now, so they dismissed your story. And I thought that yourself, and especially the guy in the foreclosure person, I think he spoke well, and I just what you were saying resonated with my way of thinking, and so I got on Twitter and I said to Stephen Koukoulis, I'll take the bet. A bit of argy-bargy. I wanted to throw Hobart in there, but he said he had a bit of a soft spot for Hobart, so I left it out. So all that has to happen for me to win, look, I'll be straight up, Martin, I do not want to win this bet. I mean, where's the joy in having that happen? It'll be like a grand final draw to me with no extra time. To me, it'd be deflating. Yeah, so he's accepted the terms. So in 3 years' time, Sydney or Melbourne or the both have to fall 35% from the peak. I think they've already added 7. So this decline, let's be realistic, is to go from 1.15 million to 750,000 on a house in Sydney, when the long-term price-to-income ratio would suggest a house should cost $260,000 or a nurse should start on 200 grand a year.
Yep.
So something has to give.
I think that's a really good way to think about it, because if you come back to more fundamental ratios, then you're right. The average home price in Sydney is still off the scale. And as you say, even if it came down 30, 35%, you'd still be above what it should be. And of course, the lending standards are 40% tighter than they were a year ago, right? So I look at what I call mortgage power. In other words, for a given level of income and a given level of outgoings, how much can somebody borrow today relative to a year ago? And on average, it's 40% lower.
Yeah.
So that means the prices can only go one way. And that's down. So it'll be interesting to see over that 3-year period. And I was talking to Stephen Keane the other week, and he was saying, well, the issue was that he didn't foresee the amount of support that the government, effectively via the RBA and through other mechanisms, government support over a long period of time for the housing sector. So effectively, the debt ran up to very high ratios. And it's worth reflecting on the fact that even now, credit, according to the RBA, is still growing at 5.4% on an annualized basis, right? 5.4% is still growing, which is pretty remarkable. And then, of course, within that, it's mostly unoccupied rather than investment borrowing. But we're seeing the trend down. And my own view is that as the credit growth eases, effectively that's going to be more than enough to take the prices quite a lot lower. So we do that modelling in our different scenarios. So I still think that, and I agree with you. I wouldn't be a good thing necessarily for prices to drop that far and you win the bet. But it is relatively realistic, I'd have thought, in that time horizon to see those sorts of numbers.
For a share market chart, it'd just be a Fibonacci retracement.
Right.
So what I'm saying is houses are going from nosebleed levels to significantly overvalued. But I think once they get to that significantly overvalued level, we're going to see a paramount shift in sentiment towards property. And then people are going to hate property. There'll be another Royal Commission. I don't know what's going to happen with interest rates. One of the other factors is early next year, there's new credit card regulations coming in.
Yep.
So people aren't going to be able to juggle their mortgage payments on credit balance transfers, and I think a lot of the Harvey Norman Go MasterCards will be reinstated. These are the ones you got your 5 years interest free. A lot of people haven't used them, but I can see use in that increasing. From a police perspective, unfortunately, I see insurance fraud is going to be a growing industry. You probably see a lot of boat fires around the place. Right. A lot of Aston Martin, Porsches just on fire or crashed or stolen. I think that's a really sad aspect. And I think no government politician or economist paid $500,000 a year to keep the peace is going to be aware of the social consequences coming. And I'm only talking about a correction, Martin. If houses went back to the long-term trend, they're almost going to drop $900,000 in Sydney. I mean, I'm not predicting that. I'm just saying I've viewed .com bubble. I've viewed the lithium bubble. I called that. I was a day out calling the top of the lithium bubble. I got .com wrong by 2 weeks because I always said in a bubble, the bottom or top's in when a punch is thrown in a dealing room. And I saw that. I saw some violence. But this gives me the impression that a lot of people have gone out and bought 25 properties in the western suburbs of Sydney. And why the hell would you do that when it's going to cost $400,000 to liquidate, or you can go via Purple Bricks and you're still going up for a couple of $100,000. I'm really concerned about this country. I know the public would want to see someone more famous, like a David Koch, a Michael Pascoe, or someone, Shane Oliver, Shane Oliver's one of the best out there. He's actually being reasonable and he's speaking his mind, which is good. Roger Montgomery's calling for 40% off as well. But I think because I'm a street fighter, I'm not university educated, I deal with the psychology, people are probably expecting someone more famous to come out and say it, but it's not going to happen. It's not going to happen.
No, well, indeed. And of course, a lot of the mainstream commentators are associated with some of the major banks and those sorts of things. So they're always going to be conservative in their view. And it's interesting how each time they come out, they're sort of adjusting down their how far prices are likely to drop. So we're going through that process at the moment. And even Stephen Koukoulis, I think, was quoted in Sky the other day saying he's now worried, right, so about the rate of fall. And it's interesting to think about the potential levers, because some people have been saying, well, surely the Reserve Bank is going to cut rates, surely credit rules will be loosened to allow the resurgence of property, or perhaps we should encourage migration because effectively that will help to create more demand. And to which I reply, I don't think any of those would be powerful enough to reverse, and I think it's highly unlikely that we are going to see significant cuts in interest rates from the RBA unless the economy goes really much weaker than it currently is, though I am calling the next rate move down rather than up personally. I don't think that there is any chance at all of looser lending standards, because I would argue that the lending standards now are just purely where they should have been all the way along. We went through this sort of 10-year bananas period whenever everybody, if you got a pulse you could get a mortgage. And it's worth reflecting on the other thing about positive credit, right? Because now positive credit is in place, and over the next few months, as that gets effectively data populated, we'll start seeing households not from just the mortgage perspective, but their total debt portfolio. And that will be a shock to many lenders, because I know from my household surveys that in fact many borrowers have multiple loans across different lenders and won't necessarily have declared everything to everybody. So I think that'll be another reason why credit won't bounce back. And I think the migration thing's really interesting, because now we're starting to see people questioning, how many is too many. And even in New South Wales last week, there was a comment from the Premier there that we should take a breather on migration to allow things to catch up and to get some of the infrastructure. So it looks to me as though all of the levers that people were talking to in terms of expecting to see a recovery in home prices just aren't there. And then if you overlay the other factor, which is that effectively we've got the construction sector now, of course, which is a huge proportion of the economy, beginning to show signs of weakness, with the inability to sell the properties that have already been built, the slowing of the ones that are being constructed, and the fact that new construction starts is falling away as approvals slide. So you can sort of see a scenario where the property sector and the finance sector's deadly embrace continues to move. And then, of course, what concerns me then is the flow onto the broader economy, right? Because effectively, suddenly, you haven't got those growth engines that you had. You've got people still with very high levels of debt. You've got house prices falling, so the wealth effect is going into reverse. And then that puts some question marks in my mind about the broader economy, which in turn, of course, has an impact on the broader investment environment, doesn't it?
It's the most frightening scenario. And I think if viewers haven't seen The Big Short, don't mess around and do it. It was that scene where Steve Carell's with the stripper, and suddenly she's got 5 loans, and it's an itsy bitsy gully. Now, we're probably not at the itsy bitsy gully yet, because the falls should stabilise, but let's remember that Sydney got to 13.6 times price to income. The US just over 5 on average before it crashed. Now, I think viewers should know that property in Australia hadn't done much for 120 years. The price to income and the real price index pretty much flatlined for 120 years. There was a spike, and that spike happened at the end of World War II, which I would say part of that spike is justified in the fact that Australia could move forward, and a lot of men came back from war and were able to see increased demand for housing. I understand that. But this isn't a land bubble. This is a combination of a land bubble and a banking bubble. So all that's happened is cheap money, the chart of cheap money has matched the rate of growth in house prices. And I just think we are in the most precarious position this country has ever been in. And there's no levers left for the RBA to pull. No one's got the money. And who's going to buy these properties at 13 times price to income? Yep. The public will become aware of it. And I was in Dublin in 2010. I did half some good stuff on the stock market. So I went and spoilt myself with a Pearl Jam concert in Dublin. And the front page of all those newspapers were people in negative equity. Teachers, firemen, emergency services people that couldn't move. Now, what's gone different, Mark? I was a cop in Bondi, and I was able to afford a comfortable unit and walk to work. Now people have to live past Penrith and commute. And you saw this suburb in the Australian part of the paper on the weekend, this new suburb out in the outer stretches of Melbourne with no services.
Yep.
I mean, it's Ireland. It's a sequel to Ireland. And people will say, oh, we're different to the Irish because we've got a different accent and we've got better beaches. That's all true. But no, I mean it. But can you justify 13 times for the Sydney Opera House and the Harbour Bridge? And I had to laugh. I was reading Twitter and someone said, well, the clearance rate is low today because everyone's betting on the Everest. I mean...
Well, there's a certain amount of trying to find alternative explanations. It's a bit like the auction clearance rates. It keeps falling, and then people say, "Oh, well, there's always a reason. It was raining that day, or whatever." But trends don't necessarily lie, and I agree with you. I think there are some scary parallels between Ireland a decade ago and where we are now. And I guess one of my frustrations is I don't think that the regulators are actually thinking enough about these small worst case scenarios. The financial stability report that came out last week basically was saying, well, there's a little bit of issue, but nothing major and it's all fine, right? And I'm thinking, well, if that's genuinely how they are thinking about the economy now, then that doesn't give me much confidence that there are people thinking about what happens if we get some of these more adverse outcomes as in Ireland. And if we're just going to be surprised by, this down the track, then that's a big deal, particularly, of course, in the context of higher international interest rates and the fact that the banks here are borrowing a lot from overseas to fund their book. So you've got a portfolio of investors. Are you telling them things in terms of how to hunker down, how to prepare for the downturn that's ahead, or is there no sort of generic thoughts that come to mind? Do you have to take it case by case by case?
I don't think anyone's licensed real estate advice, are they, these days? So I had a client who is right into the stock market, and he had someone that offered him $1.8 million for a unit in the eastern suburbs of Sydney. And I said, well, if they're paying $600,000 too much, I think you should take it. And they bought this without even looking at it. And he said, well, where am I going to live? And I said, well, there's no shame in renting because rents are falling. It just doesn't make sense. And a lot of people, I get into a taxi in Sydney and the guy's bought in Sans Souci in the 70s. And he's saying, well, what do you think of property? I think it's going to fall. But he won't take the $1 million windfall because he's got memories of the house. And as I say to people, you're only sentimental about things you can afford to hang on to. Because once there's panic, all bets are off. You'll sell your cat. You'll sell anything. You'll sell your mother-in-law. Cash. And so what I'm telling my clients is, I've made my views very clear. All my clients aren't going to agree with me. In fact, I'd be worried if they did. So I'm there to make the money in small cap stocks. So that's my constant. So regardless of what the Dow Jones does or what people are saying on Twitter, that's all I do is identify companies with 500% potential. I went and looked at a place in Yokine for $650,000. I think the upside's $900,000 up. $900,000. I went looked at a place in Glendalough with 50% upside and 6% yield. Look, I'm stretching the figures. It came in at 5.8, but let's call it 6. So I think that because Steve Keen fundamentally called it right, but Australia got bailed out by China, and the government gave us $900 to spend at JB Hi-Fi. And people were saying to me, oh, Tony, you're just another Steve Keen. Look what happened to him. Or I'm another Martin North. Because I think if we're in the street, Martin, and some cougars were walking past, they'd recognise you before they recognise me. So, but I think what you're doing is providing balance. Before the Irish bubble crashed, they had a debate with a bull and a bear, and I think I'd like to see the likes of Kouk or Pascoe or John McGrath engage in a debate with either yourself and I or Lindsay David or Roger Montgomery, at least to give people both sides without boxing gloves. And I think the Australian public deserves that, because top executives from the big four denied a banking bubble exists. I mean, ouch.
Yeah.
And a lot of young home buyers, they're not financially literate. Can you imagine if you're buying a house and your agent said, do you understand what a price to income ratio means? And do you understand you're paying 4 times the average rate? Would you sign that document? I've got one bad statistic. The Sydney property market was priced at the same level as Japanese stocks in 1987. If that doesn't scare the shit out of you, Martin, I don't know what will.
Well, it's certainly, the DFA philosophy is not just to peddle a particular view. We try and get diversity in the views, and we try to get different perspectives, and we talk from mortgage brokers and financial advisors and people in the property sector. But it's really tough now to try and get those who were and presumably still are property bulls to come and talk to me about this stuff, right? Because essentially I think the data's on my side, right? And so what have they got to peddle other than the hope that somehow the Reserve Bank will, pull a rabbit out of the hat, or the APRA will reduce the credit standards in some way, or there'll be some other miracle, because miracles apart, there's not much to say. So
yeah, the only way that to have debts forgiven is the ugliest word, hyperinflation.
Yep.
That's all I'll say.
Yeah, well, of course, and John Adams, who often collaborates with me on posts, is of the view that it's quite likely that we will end up with a lot of money printing, a lot of QE, and a lot of hyperinflation, because effectively that's pretty much the only shot in the locker, which is essentially kicking the can down the road, but doesn't fundamentally deal with the debt problem we've got. And remember that debt in Australia on a household basis is probably higher than almost anywhere else around the world. And the thing I worry about is the generation of people who have these massive debts, and I can't see how in the normal course of business they'll ever be able to repay the loans they've got. So even if we kick the can down the road and continue to inflate house prices, the debt bomb is going to go off.
It has to.
Yeah. And that's that.
Yeah, I know. And it's very sad that a lot of people that have worked hard, law-abiding, paid a lot of tax, just watch TV, haven't been attuned to what these graphs, haven't looked at graphs of house prices. Suddenly they're out of an SUV and bankruptcy. You're forced to drive a $7,000 car and go through that, the indignity. I'm really concerned. And as I said, I don't want to win this bet at all, but it aligns with my view. But Martin, we can't save it now. There's no levers left. We've passed the point of no return. Banks' duty is to their shareholders, not to people with mortgages. And the only way the bank really cares if you're alive or not is when you miss a mortgage payment. So it's really sad what's happening to Australia. Luckily for people in Sydney and Melbourne, if you want to move away from people you don't like, there's reasonable markets in Adelaide. Perth's got a lot of growth. Just wait for Perth to settle. Oh, this is a fantastic place to live. I mean, I was a cop in Sydney for 8 years. I worked the roughest areas. I worked the best areas. I know where I'd rather live. And couples that can get transfers, or if they're cleaning jobs or Uber or taxis, why not come somewhere and live without stress? I mean, PIMCO was saying that mortgage payments were going to be 48% of someone's income. I mean, life's too short. Life's way too short for that. And this buying 0 to 134 properties, morning TV loves people that own lots of property. They're not going to run a story on a kid that's built up a share portfolio without leverage, are they? It's ridiculous. And we worship the property people. We worship celebrities. Thank God Meghan and Harry are here at the moment, because we've got this massive crisis forming. Yet we want to watch her hug a koala. I mean, Australia, get your priorities right. And I really admire what you're doing, Martin. At least you're giving people a chance to look at it rationally. If they believe Kouk or Pascoe, that's fine. In the end, I hope that I'm proven wrong with this bet, and Australia house price to income deserves to go to 20 times. God knows why. It's not going to happen. I mean, the only really valuation uplift before this madness was the end of World War II, and I explained that some of that was justified. So I'm very concerned about Australia. I'm more concerned about the social issues and young families who don't deserve what's coming brought upon them, because it's speculators that have caused this, and that's it. There's distorted prices beyond any reasoning, and I don't care. Immigration, what bollocks. Supply, demand, what a load of bollocks. I mean, rents are falling. I mean, go to Docklands and it's 70% unoccupied. I made that up.
Well, but we certainly know that there is, there's about 1 million properties that are empty across Australia. And if you look at the ratio of numbers of people per household, per property now and 20 years ago, there's no change. If there had been an undersupply, you'd have seen that go up. So I think the supply, lack of supply story is just, not true. So that's one of those other myths that are out there.
It's also the same beauties on the inside, isn't it, really?
Yeah. Exactly right. Well, Tony, that's been really interesting, and I appreciate your time and your perspectives, and it'll be very interesting to see how this plays out over the next few months. Perhaps we should catch up again down the track a bit as the trajectory continues. But I think the message is go west, young man, isn't it? Come over to Perth. That's where the opportunity lies.
Or even Adelaide, I think would be nice. I like Adelaide too, but get the latest in Melbourne if you've got a chance, and get away from people you don't like, which is probably your family.
Tony Locantro, thank you very much. Good to talk to you.
Absolute pleasure. Thanks, Martin.
Thank you. So there you have it, right from the investment manager's front line. If you found this useful, please like the post and share, and do leave a comment or a question. I do read them all. And if you enjoyed this post and would like to subscribe, please do so to receive alerts as we release new posts. And you can always support our efforts via our Patreon program. There's a link below to that. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you next time.